We're here to talk about Silicon Valley real estate market. It's May 18th, 2024. Here's the first data slide. This is a summary of what we're going to be talking about later on in the video. We'll talk about the active inventory. We talk about the offers accepted versus the pendings. We talk about the ratio between the two measured in days of unsold inventory, both compared to the 10-year median and currently. We look at days on the market, and instead of looking at the average or median days on market, we look at the 75th percentile, which is 3 out of 4 sellers sell in that time or less. We look at sellers' ask price reduction, both the magnitude and the frequency. Then we flip over and look at the buyers, what their overbidding is, both the magnitude and the frequency. Then we look at the long-term appreciation from 2015. And finally, we look at the sold price, and we look at the median, which is the middle number like most people, but we also look at the 10 and the 90 percentile. So you have a sandwich. And we also look at what your estimated monthly payment is, assuming an 80% loan and 30-year fixed at the national average. We've changed the order a little bit, so we're going to talk about Silicon Valley to start with, which is Santa Clara County, Alameda County, and San Mateo County. And this slide really tells a lot, and then we'll get into details. The purple line is the inventory, and look how much the inventory has shot up basically in second quarter. The vertical line here is the separation between the end of the first quarter and beginning of second quarter. And basically since then, your inventory has gone up quite a bit. Now we go down and we look at the orange line. That's the number of offers. Offers went up, but they didn't go up right at the quarter break, but they waited about 3 or 4 weeks, and then they've gone off. And more importantly, look at this last week. This last week looks fairly level at the same time that inventory has skyrocketed. Now, I'll warn everybody that we're going into a holiday weekend, which accelerates the sellers coming on the marketplace because nobody wants to come on next weekend. So they race and come on this weekend. So you have an increase in inventory just this week, and we haven't had time for the offers to be accepted. And I'm also a little surprised that the number of offers didn't go up from the increase from the week before. And then the more critical number is the days unsold inventory, which is the ratio between the two. In a free economy, the supply demand, which I measure in days unsold inventory, is what drives the marketplace. And you can see that there is fluctuation, especially at the end of the first quarter, which was Easter and also Cesar Chavez holiday. But we also had a dip just here, which I cannot explain. And now we're going back up again. Typically, you're going to have an influx of inventory coming in to the holiday. So that would be this run up here. So I can explain this. What I can't explain is this dip down. But you can't explain everything so quick to when it's happening. Now we're looking at the seller price reductions. And what these are distributions for each data point. I start off a year ago, 12 months ago. I do monthly up until 3 months ago, and then I change over and do weekly. But the blue dotted dashed line here is where we were last year, and the green dotted dashed line is where we are this year. Basically, there are very similar pattern up here on the sellers that are taking the biggest price reduction. So basically starting right at about 7.5% of the sellers to somewhere around 10% of the sellers, there's a marked difference in the distribution. In other words, a year ago, 12.5% of the sellers were taking some percentage of reductions, and that's why the line came down. This year, even though the latter part of the line is the same, it holds on until about 9.5%, 9.75%, maybe even 10% of the sellers. So you have 2.5% fewer sellers doing price reductions. But the other thing that's noteworthy is the green dotted dashed line here is significantly lower than the solid lines. And the solid lines are the recent past weeks. So we've clearly gotten past the least amount of seller price reductions, and sellers are starting to take more price reductions. I'll step through. This is starting off a year ago. So look at the blue dotted dashed line. So there it goes down and it bounces around and way down. And there's about 6 months ago. Now it jumps up, and now you're on the weekly. Right here is approaching the peak of the marketplace, probably that blue line or the orange line. And so you can see about the last 3 or 4 weeks, we've come down. In fact, we can go back up. That is that or the peak. So basically middle of, and so anyway, you can see that we've come down. Now we're flipping over and we're looking at the overbidding. So this is what buyers are doing, the amount of competition. Concept is the same. We're starting off a year ago. The blue dotted dashed line is where we were a year ago. The green dotted dashed line is where we are right now. So significant improvement in the marketplace, measured by increased overbidding. So buyers are seeing more competition, so they're overbidding. So the buyers are obviously saying that's a worse of market, but you have to take one perspective to talk about it. And I look at the seller owner's perspective. So the market's clearly stronger. But now you're also at the peak. But remember, in order to get this ratio, we need the sold price. So this data is 5 weeks ago. So probably in another 2 weeks, we'll start seeing this line to start coming down to reflect the decrease in seller's ask price because of the cooling of the marketplace. So we're hotter than we were a year ago, but let's step through, and there we were right about the peak last year. And then you drift down starting at about 4 months in the future. And then you can see we're coming up 8 weeks ago, 7, 6, 5. They're sort of the peak. So we've been at the peak for about the last 4 weeks, and now we're back to the current line and a year ago line. So the market is hotter than we were a year ago, but we're sort of at the plateau. And because of what's happening with seller price reductions increasing, I would expect the amount of overbidding, both the magnitude and frequency, to start decreasing in the very near future. Now we're going to look at Silicon Valley as a whole to start off with. The micro markets are coming up at the end for those that are curious. Here we have all 3 counties. That's San Mateo County, Santa Clara County, and Alameda County all together in the market and what's going on. So again, this is active inventory. The 3 thin lines are annual cycles. So you can see there's a huge annual cycle in inventory, and we're still on the climbing part. We don't get to maximum inventory until about the middle of July. But notice this year, we were down very close to the red line through first quarter. In fact, all of 2023 and 2024, we were very close to the red line. That's low inventory, which would be an aggressive market. But look at what's happening. And no one's talking about this. Everyone's talking about the lack of inventory. But look at what's happened in second quarter. And yes, we're only halfway through second quarter, but look at the increase in inventory. And notice how you're getting closer to the gray line. That's what the gray line is, the 10-year typical active inventory for this week. So you've gone from a very limited inventory to almost normal inventory. So we're not quite at normal inventory, but there's a huge difference. And what you want to pay attention to 2 slides from now is look at the pattern of the offers. So here is taking that curvy gray line and straightening it out. And you can see that, again, right starting at the end of first quarter, beginning of second quarter, we started gaining inventory. So we still have a shortage of about 10% of the inventory, but we clearly are coming up. And, we now have more inventory than we've had basically since 2020. And that's pretty significant. Yes, there was more inventory at the end of 2022, but that was, when we went from extremely limited to surplus. But for people to be focused on lack of inventory when we basically have almost more inventory than we've had for any period of time since 2020, I think is missing the boat. So that's just my observation. Now let's look at the offers. So here are the offers, and look at the trend, the seasonal cycle of the gray line, very seasonal, just like the inventory. But notice, unlike inventory, the number of offers is not pulling away from the blue line. That means the buyers are not scrambling to come out and buy that inventory. To me, that's saying the general perception that we have lack of sales based on lack of inventory isn't holding water, because if that was the case, as soon as there was more inventory, you would have expected more offers, and you would have been pulling away from the blue line and approaching the median line, the gray line up here, which we're clearly not doing. And in fact, if you look at the last data point up here, it almost looks like the upcrease that we're having is leveling off. My position is, yes, we have a lack of buyers, but it isn't a lack of buyers because of lack of inventory. It's some other condition. And that's why I do quantitative analysis of the marketplace. I don't care the reason why their lack of buyers are out there. All I want to know is there's a lack of buyers out there. Here's the number of offers, and you can see the offers have increased, but we're only at 80%. So if you had 90% of the inventory and offers were being restrained by inventory, you'd expect 90% of the offers as well. And here we're below 80%. So I think that says it in a nutshell. And also just look at how that for 2023, that was very constant at 70%. So yes, there was an absolute lack of inventory in 2023, but you've gained 10% of inventory here in just the last couple of weeks. and you haven't gained that same amount of gain in the number of offers. Now we're looking at the days on sold inventory. This doesn't look so concerning, but basically the days of unsold inventory, which is the speed of the market, the balance of the market, has basically been right where you'd expect it to be. But notice again in the second quarter, we're now slightly above the gray line, which is a slightly cooler marketplace. So we're actually having a slightly slower marketplace than we normally do for this time of the year. And that's hard for people to believe because we've had a fast marketplace and we've had very limited inventory, absolutely, but the market is slower than it should be. Here you can see that you're above 100% and you're almost, 115%, 118%, something like that. So the market is slower than it normally is. And a slowing marketplace usually indicates prices will at least stabilize, if not reverse and go down a little bit. Now we're looking at something that's a little easier for the consumer to understand, and that's simply days on market. And instead of looking at the average days on market or the median days on market like the general public does or the industry typically does, I look at the 75th percentile. And the reason I look at it is very demonstrated right here. I'm trying to get away from this stair-step function and trying to get a very smooth curve so you can see what it happens. But I would have had to use even a higher percentage. And statistically, you typically look at things in quadrants, and I don't want to do things too abnormal. I gave some thought to, and I will look at it again and consider, like I do on sale price, look at the 10 percentile and the 90 percentile. So look at the 90 percentile days on market, but I have not done that. Again, here you can see that we're faster than normal, but again, we've had a big run up, and the run up into the time on the marketplace happened earlier, but that's just, this is actually left over from the end of the year. There's basically no inventory at the end of the year. The buyers come out of the woodwork right at the first week in January. Sellers don't come out to about the third weekend in January, and that's why this big run down and then back up. Here's looking at the seller price reductions. So again, we're taking slightly more price reductions than we typically do. If you were taking the normal number of and magnitude of price reductions, you'd be right on the gray line. Here you are, you were down here taking quite a bit more. The market improved, so you got up close to the median. And now, again, it looks like you're pulling away a little bit and you're going closer to that blue line. Here's what it looks like when you pull that gray line straight. You can see that you have more price reductions than you typically do, which is why it's on the blue side of the line. Here's looking at the largest 10%. So I'm saying this index is so stable, I'm going to ignore 90% of what the sellers are doing and only look at the sellers that are taking the biggest price reduction and how big of a price reduction are they doing. And they're actually they're below the blue line now, which is the most price reductions you would expect. The 10% of the sellers that are taking the biggest price reductions are taking bigger price reductions than you would ever expect in a typical marketplace, which again indicates slowing. Here's on a percentage basis, and you're probably about 35% more larger price reductions than you typically would expect for this time of the year. And granted, this is the time of the year where there are small price reductions. Here's the frequency. So the frequency is right where you'd expect it to be, right on top of the gray line. It's been basically on top of the gray line since halfway through 2023. Yeah, there was a little diversion at the end of 2023. So, if you want to say halfway through fourth quarter of 2023, it's been right on top of the gray line. That's probably the best assessment. But so the frequency, so sellers aren't taking more common price reductions. Here you can see that you've been basically right on the gray line. Yes, you bounce up and down. Real estate is very cyclic. And when you look at things, even though I'm looking at the same dates, the fact that they're different days of the week impact the data. Here's looking at the average overbid. So this is what the buyers are doing. And I warned back here that it looked like we were leveling off. It looks like we actually hit the peak and now we're coming back down. So you have a plateau here, you have a plateau here. I would predict a plateau here for another 45 days, probably ballpark, because this went through all the second quarter. This went a little past second quarter. Anything can happen, but for now, I would expect the overbidding. It's done for the year on its increase, most likely, and it will most likely be at a plateau. Here's looking at it, and you can see that we've gone up in the last couple of weeks. We've been flat, and then this last week, we were actually down a little bit. And with the large inventory that came on this last week, I would actually expect this to go down a little bit. I almost expect we now have more inventory than we have buyers, and we will find that out. Here's the frequency of overbidding. You can see we're rolling over like the graph does. We're a little bit less common than you would expect, so there's fewer sellers taking price reductions. This is pulling that gray line straight and looking at it. It's been fairly constant with fewer sellers taking price reductions than normally do. Here's the long-term appreciation. You can see we start back in January 2014. We come all the way up to current. You can see every year the downturn at the end of the year. Yes, the downturn in 2020 was basically a U-shaped, and in 2021 it was basically a flat line. But every other year there's a significant downturn in price. That's just the makeup. Real estate is an optional event where there's holidays, the end of the year festivities. Buyers are busy doing other things, and so the real estate not only decreases in volume, but it also changes the demographics of who's buying, and therefore the size of the home is buying. But again, we've sort of leveled off here, and I would expect to come back down and somewhat approach that long sloped line here, which is the long-term guesstimation of appreciation. But look at what we've also accomplished. We went from about 1.4 million to 1.75 million, which is an increase of $350,000 on the median priced home. And we did that in 135 days, less than half a year. That is pretty incredible. We do that every year, though, at this time of the year. Now we're looking at the estimated payments. You can see they rolled down. Interest rates came down a little bit, plus payments. The low end is basically flat, which means it probably went up a little bit in price to compensate for the slightly lower interest rate. Here is just a table. The real key is the bottom line here. This year, we got 2,341 offers were accepted in the past 5 weeks. The only year that was worse than that was 2020, which was when we had shelter in place and weren't even supposed to be showing properties, and we had 1,735 homes. But come back here and look. These are increasing significantly, and we were able to show homes starting May 1st. So when you look back 5 weeks, I would expect that number to continue to come up. What does that mean? That means that the current year, 2024, will likely become the slowest year again. You can see all these dark blue up here where it was the slowest year. We've been the 9th slowest year for the last several weeks, but that again is only because the pandemic 2020 was lower because we weren't able to show property and not that many new buyers were writing offers when they couldn't get in and see houses. And initially it was you couldn't see anything, then you could see vacant homes, and finally starting on May 1st or 2nd, I think it was, we could start showing houses under some fairly significant restrictions. Now we're leaving Silicon Valley as a whole and looking at the 3 counties that make up Silicon Valley. They are Clara County in the blue, San Mateo County in the orange, and Alameda County in the gray. And right off the bat, I need to come back and verify this data point because it's just out of line for it to be up that high for 1 week. So I will try to remember to go back and look at that. The takeaway is the inventory has been going up in all 3 counties. You can see that Alameda County has the absolute most inventory, followed closely by Santa Clara, which is the long-term pattern. The gray line is normally on top, followed by the blue, and San Mateo County is a smaller county, and therefore it has less inventory for sale. San Mateo County probably has very close to its normal inventory, where both Santa Clara County and Alameda County have less inventory, as you can see, and that's why Silicon Valley has less inventory than normal. Looking over at offers accepted, here, gray again is typically on top, although probably slightly closer to blue, but now blue, Santa Clara County, is way on top of the gray, Alameda County. So that basically says there's a lot more activity happening in Santa Clara County than there is in Alameda County. And San Mateo County is also down from its typical level. So San Mateo County has the normal level of inventory, a lower number of offers, so it's got a slower marketplace. And that's what we're seeing right here. Normally, the orange line, San Mateo County, is on the bottom, which is the fastest marketplace. You come up to the pandemic in 2020, and boom, it changed. And now San Mateo County is sort of the highest line. What's that really saying? It's saying that San Mateo County used to be desirable with pandemic and modified work schedules, people are willing to commute longer distances and are not paying the premium they used to for San Mateo County. Sellers aren't willing to give that premium up, so you end up with a slower market. So Santa Clara County is the fastest of the three counties, and San Mateo County and Alameda County are tied, although San Mateo County is typically faster than Alameda County, although the reverse has happened since the pandemic. Now we're looking at that benchmark of 75th percentile of time on the marketplace. You can see that Santa Clara County is the fastest at 13 days. It looks like Alameda County and San Mateo County are tied at 15 days. All three counties are selling in essentially under 2 weeks on the marketplace, which is a fast-paced marketplace. That's 3/4 of the sellers are selling in 2 weeks or less in Silicon Valley, in all three counties that make up Silicon Valley. Now we're looking at the magnitude of the list price. And here you can see that Santa Clara County is sort of taking the biggest price reductions. San Mateo County is in second place, and Alameda County is taking the fewest price reductions. So those sellers are doing the least amount of adjusting their price. I don't know if the market's more aggressive up there, they're doing their homework better. For whatever reason, Alameda County, and it's not significant, but this is a very tight metric, which is why on that one of the earlier slides, I only looked at what 10% of the sellers were doing. Here's the frequency. So it's most common to have price reductions in Santa Clara County. Alameda County is second, and San Mateo County has the least amount of price reductions. And I think what's happened there is San Mateo County was slower. Sellers were lowering their expectations, and the market there finally is sort of catching up, and so they don't have to adjust their price. You can see they were doing quite a bit of price reductions just earlier in second quarter. Now we're looking at the amount of overbidding. This is what the buyers are doing. So the buyers in Santa Clara County and Alameda County were doing the most overbidding and very similar to each other, but Santa Clara County rolled over and came down a little bit the last couple of weeks, where Alameda County looks like it's still just slightly climbing. But again, if I look at that and know what the typical market is, I would say it's about to plateau. San Mateo County has been climbing, but is the one area where the amount of overbidding is the least. And when I say the least, it's basically just under 8% overbid. Santa Clara County is probably about 9.5% overbid, and Alameda County is about 10.75% overbid. Here's the frequency of overbidding. So not only does Alameda County have the most overbidding in magnitude, it's got the most overbidding in frequency. That's how common it is, how many sellers are getting more than their asking price. And both Santa Clara County and Alameda County are right around 80%. Alameda County just above and Santa Clara County just below. San Mateo County is below at about 68%. So that's still 2/3 of the sellers, but that's not 4 out of 5 sellers getting more than their asking price, which is pretty amazing. Here's the long-term appreciation. You can see before the pandemic, all three counties were very similar to each other. Post-pandemic, we have Santa Clara County coming out on top, and San Mateo County and Alameda County doing roughly equally as well, but less. And what am I talking about? Well, Santa Clara County has about 210 or 110% appreciation. San Mateo County has about 90% appreciation, and Alameda County has about 82% appreciation. So fairly significant appreciation. That's only in the last 10 years, since the last 3/4 of 2015. Here's the median sold price, and you can see San Mateo County is very rapidly approaching their previous peak. There's only a little section right here in 2022 at the peak of the marketplace that where buyers paid more for the price for the typical home than they are now. Santa Clara County is just above. Alameda County is still below. So those sellers that got sold in the heyday and right at the end of first quarter of 2022 are doing better than the sellers today by a small amount. Here's the same information on regular paper for those that prefer. Here's your estimated payments in the same order. You can see because the San Mateo price went up so much, their payments still went up. Santa Clara County came down a little bit, as did Alameda County. Here's the actual raw numbers for you. A few takeaways. Inventory has been growing. We had 3% more new listings coming on the market in the last 5 weeks than we did last week. So that's more inventory coming on the market. Inventory is up 18% in Santa Clara County, only up 2% in San Mateo County, up 11% in Alameda County. So your inventory is growing for Silicon Valley as a whole. It's up 11.7%, call it 12% increase. But the number of offers only went up by 1.5%, 1.4%. So if we were in an inventory restricted marketplace, these two numbers should be matching. Now there should be a 1-week delay. This is warning, and you actually went down in Santa Clara County. So you had more inventory come on the market even last week, even though I don't have the data in front of me, and yet your number of offers went down. Days on sold inventory slowed by 5 days, and that's sort of my threshold of we're in a changing marketplace. San Mateo County actually accelerated, so that market's still improving. Alameda County slowed down by 3. Silicon Valley overall slowed down by 3.3. Days on market for the offers accepted, you can see you're very respectable, and this is the median days on market, the average days for those that want to look at it, and the number that I think makes more sense, the 75th percentile. All 3 of them are up there, so you can compare them. The problem with the median is it jumps. The average gets skewed by one person selling after a long time on the market. The 75th percentile doesn't have either one of those issues. And this is seller price reductions here. Very small price reductions, right around 0.6%. Alameda County is only 0.4%. And then you get into closed data, the last segment of this table, and that's delayed by 5 weeks if we need escrows to close. Now we're getting into what I call the micro market areas. As you can see, my resolution went down. I'm going to try to improve that. But the real takeaway for long-term viewers is look what happened just a few weeks ago. This was all red in color, showing a lack of inventory. Right now, it's white in color, no color, which basically says you have normal inventory. Normal inventory is considered from 87.5 to 12.5% above the normal. So 12.5% on either side of normal is no color. And that's basically where all 20 micro market areas in Silicon Valley are. That to me is telling San Mateo County has more. The order here, the letter depicts the order, so that's all the same. U is just sort of a separator, and this is the key. So you can see a hot marketplace is from 50 to 87.5%, a shortage of inventory. Here's looking at the number of offers. So even though the inventory now is back to normal, your offers is still fairly blue in color. That to me, as I've said several times already, indicates that we are not in a market restricted by inventory. Here's your days on sold inventory. So we're basically a balanced marketplace, but look, you got 2 areas that are red in color and 3 areas that are blue in color. So the market's actually slower in 3 areas, and these are fairly decent size. South County is big, but they're outlying northern San Mateo County, Daly City, San Bruno, those areas, and then the coast. And Foster City is a very small micro market area, so you just disconnect that. The only one that's red that's of any size is Saratoga Los Gatos, and that's really not that relevant. So you look at the heart of Silicon Valley, and it basically saying we're having normal speed of the marketplace. So people that think the market's fast-paced, this is where we've been for the last 10 years. Here's just the raw numbers. This is indicating that we're still pink. So yes, the market's fast, but it's not fast to compare to where it normally is. And because real estate is so cyclical, you have to compare to normal. Here's the 75th percentile. I will probably change the benchmarks of these in the future, but for now, from under 3 weeks is a seller's marketplace, from 3 to 6 weeks is a neutral marketplace, and above 6 weeks is a buyer's marketplace. My concern is, since this only includes the successful sellers, the metric might be a little too tight, and I might have to cut this down to 14 days. Seems a little too far, but I haven't figured out what I want to do yet. I may use 5 weeks and 2.5 weeks, something like that. Here's the ask price adjustments. Again, you can see the color has gone away and it's basically white. You got a few areas that are blue and a few areas that are red, so they're sort of balance each other out. Here's the frequency. So still very uncommon to have price reductions. I consider from 5 to 17% to be a hot seller's marketplace, and most of these are closer to 5% than anything else. From 17 to 20% is a balanced marketplace, and above 20% is a buyer's marketplace. And the reason this metric is so tight is sellers do their homework before they go on the marketplace, so they don't have to reduce their price. Here's the buyer's overbidding. So there's still quite a bit of overbidding. The pink color is from 1.5% to 17.5% above the seller's ask price, which is where the bulk of this market is. This lags behind. Remember, I need sale price. So this data is not where the market is today, but where the market was 5 weeks ago. Here's that frequency of overbidding. Again, very common. From 50 to 95% of the sellers are getting more than their asking price. And for the most part, it's right around 80%, 3/4 to 80% for most of the areas. Here's the long-term appreciation. And this is really telling. Look at the areas, the cities, the highly densely areas have the least appreciation. I think that's directly related to the pandemic. The outlying areas where people are now willing to commute in from have had the most appreciation. That's because of compounding. Whoever's had the most appreciation in recent years, i.e. since the shelter in place, has typically the most overall appreciation because of that compounding. But again, it tells you people are now willing to commute further, and that's where the demand is. So the prices have gone up in those areas. Here's the sold price. And here you have the middle numbers, the median. You have the 10 percentile on the left, which is the cheapest, and then the 90 percentile, the most expensive on the right. So you're sandwiched. So you know the price range in each. And here color is simply the affordability. So the outlying areas are affordable. The heart of Silicon Valley is red in color, and that's where the prices are the highest. And here's a summary of all the different things that we've gone over. Went over this at the beginning, but that's just a second recap for convenience. So here's some of the differences. I won't go into them today between my data and almost everybody else's data. The big difference is my data is actually gathered and processed to understand the marketplace, not repeating MLSs and what they put out, which is what almost everybody else is doing. Now we're leaving the Silicon Valley and looking at the Greater Bay Area, which is 5 regions. One of those 5 regions is Silicon Valley. Then we have the cities, North Bay, Central Valley, and Central Coast. Here's the numbers right off the bat, so you can pick what you want that you believe is the most important for what you want to find. Both Santa Clara and San Mateo County are more expensive than either San Francisco and Marin. Silicon Valley overall is pulled down by Alameda County, but I think this is the first week in a long time where Silicon Valley as a whole is actually $5,000 more expensive than San Francisco, but not more expensive than the region. Here you can see inventory is growing in all of 5 regions, and you can see that inventory is still down because no matter what you pick, you come back here to midway through second quarter, your Central Valley and your North Bay should be way up here around 5,000, and yet they're down around 2,500, so half the inventory. Or Silicon Valley isn't as bad. It should be somewhere around 3,000, and instead it's around 2,400. And then Central Coast and San Mateo, the same, not as bad as Central Valley and the North Bay. Here's looking at the number of offers. All 3 of them are climbing. You can start seeing Silicon Valley is starting to level off here. It almost looks like Central Valley is starting to level off. North Bay and the other 2, the cities and the Central Coast are still climbing. Here's your days on sold inventory. Silicon Valley by far the fastest, Central Coast by far the slowest. The other 3 are together right around 50 days of unsold inventory. So to sell out your entire inventory, the existing rate of sales in less than 2 months is still a fast marketplace, but you can see there's a difference. Here's your time on market. Silicon Valley is down here at 14 days. You have the Central Valley and the cities at somewhere around 22 and 23 days. You have North Bay at 31 days and Central Coast at 39 days. So still across the board very fast, but you can see the differences. Here's your ask price reductions. Silicon Valley has the least price reductions. The cities has the most. You can see that whatever region you're concerned about. Here's the seller's frequency. Again, Silicon Valley, the theme here is Silicon Valley is doing better than the market around us. Here's the frequency. Only 10% of the sellers are doing price reductions. And it goes all the way up to 20% in Central Valley. So twice as many sellers are doing price reductions in the Central Valley. Here's the overbid. Overbidding, the cities outbids Silicon Valley. So Silicon Valley is actually in second place, but they're both at 110 to 112, 11.5%. All the others are down around 0% overbid to 2% overbidding. So completely different markets. Here's the frequency of overbidding, the most in Silicon Valley. So the overbidding in the cities that's happening is way over the top. Cities in second, North Bay and Central Valley right close together, about 55%, and Central Coast being the least overbidding at 42%. Here's the long-term appreciation. The cities doing the least amount of appreciation. Again, that happened with the pandemic, and Silicon Valley doing the most appreciation. Central Valley and Central Coast came up. Central Coast came up dramatically. I think this is a weather-related thing. You can see there's a lot more movement in the Central Coast appreciation. Here's the median sold price of the different regions. The cities and Silicon Valley very close together. Central Coast third, North Bay fourth, and the most affordable area is Central Valley. And here's the payments are going to be in the same order. Central Valley, you're paying right around $4,400 for the payments, all the way up to the cities where you're paying about $14,000 a month. Just for those that haven't noticed, I've changed my root URL to Silicon Valley Real Estate Market. So going forward, SVREM is going to be the root URL. The old one that you have will work through 2024. The handout is out that you need to drop off the G. So just Silicon Valley Real Estate Market H, and then the year, month, date code. With that, I'm open for any questions. Not seeing any unmuted mics. Thanks for joining. Take care. Bye for now.